Yeah, I'm losing my
How mean
edge.
reversion works, that is a topic of conversation here. Today, we just had a great live stream on YouTube. If you don't already, go subscribe to the Small Exchanges YouTube channel. I did a nice 30 minutes on mean reversion. It was quite a blast. We're going to do a tighter 5 or 10 minutes here on small stakes, applying it directly to some markets that are mean reverting. And today is a beautiful day for mean reversion. If I do say so myself, Pete, you've got mean reversion in the equity and interest rate pairs. Got a big bounce in metals. Got some mean reversion there. And everything is really kind of shaking. Oh, also that US dollar piece has been rallying. Some mean reversion there. So I'm glad that we're talking about this today. And hopefully people can add this to their tool belt. Because Pete, have you ever looked at a market and thought, I have no idea where this is going?
Yeah. And honestly, it's funny. A lot of times you have a bias, but I think the admitting that something you're engaged in, something that oftentimes, I don't think we all have a bias 100% of the time. Something that we have a bias 85, identifying the 15% of the time that you don't, and just accepting it like, I really don't have a good game plan here. And stepping back is one of the key parts to not over trading in my mind. Because when you were in the pit, you were forced to have an opinion every single day, whether or not you had one, and deal with the order flow accordingly. I think one of the great pieces now is that we are free to not necessarily have an opinion. And we've talked about this. How do we create neutral strategies around not having a directional assumption? And that's the next level of tradable opportunity. Because we all start with the direction, and that is a good starting point, because that you can build strategy around that mechanics and then deploy your management. It's just the start.
Yeah, it's truly one of the genius things that one Tom Sosnoff over at the Tasty Trade Live show that he came up with. He's had a few good ideas over the years, but maybe one of the best ones that Tom has had is this empowering idea of you don't have to have an idea. Like his whole thing is like, go off and read all the information about Tesla that you want. Go through all of their accounting books and all of their projections for the next year. Read Warren Buffett's article on it. Read the Bank of America analysts on it. Do all of that research. And at the end of the day, I've got my strategy that I can look at Tesla in a second and say, there's opportunity, there's no opportunity there. And him with options is truly one of the most empowering things he's ever done, which is like, you don't have to be a fundamental analyst who's done days and weeks of research to see some opportunity in the market. And that's what we're posing here with futures, different derivative, and mean reversion, essentially the same way that he uses implied volatility rank and options trading. We're looking at here with mean reversion in non-stock markets. It's this idea, Pete, and you see it so well in these two different examples, the yield and the US dollar over the last several years, whereby days, weeks, months, years can go by in these different markets, Pete, and you tend to see around the same prices. And it's this thing where like the S&P 500 back in the year 2000 was at this price. In 2005, it was at this price. In 2010 here, and now It's like way the hell up here. Whereas interest rates have always tended to be around 2 or 3%. And you can see here for the last several years, they just oscillate around that 2 or 3%. Now we have certain instances where they got down to half a percentage point.
And also up to 18. So
exactly. But
we've crossed the normalized bound, the reverting bound, several times, and not within. And I like the fact you talk about products that have, and I think equities really sit unique about the that positive drift to them. I don't think there's any other product we can actually pick out off the top of my head that has the bias drift that equities do. So it's a good discussion here. I love the fact you're pulling out those.
You try to do it in commodities even, Pete, like you try to do it with crude oil, for instance, and you could have maybe tried to do it back when crude oil got north of $100 per barrel. And even that came crashing down to a long-term mean, which is to say that like on average, if you were to pick any day in the last several years for crude oil, it's probably between $40 and $70. So
I was going to say, I was going to even tighten it up, 45 and 65. But yeah, you're absolutely right.
And it's the same with this. We're not looking at commodities today, but we absolutely will. And this lends the same way that it does not to stocks, but it does to yields in dollars, which is to say, like, a lot would have to change for the U.S. interest rate environment to just go to like 20%, or to go to -1%. And they have these long-term means that they revert around. Now, the question becomes, Pete, and this is, everybody who studies the VIX index or mean reversion in general, and they get a handle on it, they instantly think, oh, well, I can sell, if the mean here in the S10Y product is $20, I can sell 21s, I can sell 22s, I can sell 23s, and I can buy 19s, 18s, 17s, and just hold on to them. But we know with futures trading, with trading in general, you can't simply, no matter how big of a trader you are, inventory all these positions for potentially years until they mean revert. So you need to add a time aspect to it. And so with that, I'll answer the question with another question. What are you expecting from this trade? Now, are you expecting $100 out of trading the S10Y product on this long-term reversion? That's probably not enough, because then you are literally buying the 19s and you're selling the 21s, and it's not that tight, right? But if you are looking for a couple $100 or a long-term price extreme, getting down, and Pete, we did this without even necessarily calling it mean reversion at the time. When this product got down to $6 and $5 and U.S. interest rates got down to their lows, going back, all the data that I could find, going back to the 60s and 70s, we were buying that price extreme, waiting for the mean reversion of a few $100. And in the long term, you saw this, right? You saw this mean reversion play out as recently as 6 months ago.
Yeah, absolutely. And play the back and forth of that. And I think this is, you see the opportunity, whether or not, you're looking at yields or crude or the dollar, as we're talking about here. I think the great point here, and correct me if I'm wrong, is the expectations around, so you've got this great piece of product, which means there's a new aspect to it. It doesn't have a drift. It's difficult to trade, but it's got this reverting aspect to it. So how do we take advantage of that? And I think it comes from the fact of how do you set expectations around how much of this, because I think crude was a perfect example. It traded, now you and I both think between 40 and 60, 45 and 65, 45 and 70 is a reasonable range. We've seen it trade, well, let's forget the negative, but we've seen it trade 110 and 0. Neither one of those sit throughable. But we do know the product has that. But within that actually helps us define a little bit better bias at extremes around means.
Well, and that is a funny thing, right? Like, because I sat there, I was on the phone with Pete as that crude oil contract, which I think was at April or May of 2020, whatever it was. It's printing -20.
I believe that April contract,
It's printing -20, and you would say, as a mean reversion trader, oh, I want to buy as much money there is to my name. I am buying this crude oil at -20. That being said, I sat there and talked to you, Pete, and we were like, man, we can't touch this because it printed, guess what? -40. That with that product was a 20 grand loss. That if you bought even a few contracts, that could have eaten up your whole account and taken you out of that position. Thankfully, small exchange products in the long term, they don't tend to see 10, 20 grand moves. And what's really nice about that is you can set your expectations around a few $100, especially when you lend mean reversion to the short term. And this is where I want to finish this, which is mean reversion applies to so many different asset classes. Interest rates, currencies, commodities, not so much those equities, but you can attribute it to those different asset classes and different time frames here. Maybe $100 in the long term isn't really a realistic expectation for yields. But in the short term, if you're using net change of 0 as the mean for the given market, you see here expectations less than $100 are very viable for a day trading mean reversion strategy in the small exchange futures. So a lot of different ways to trade mean reversion, short-term, long-term, interest rates, currencies, and commodities as well. It's a matter of picking the right products
Right.
and comfortable in that position so that you can actually see that mean reversion play out.